Let's face it, we are all in search of that hidden edge on the markets, that sliver of information that when used appropriately can give us outsized gains over the rest of the crowd. The only problem is that most of this information is reserved for a chosen few. Either that or it's ridiculously expensive to attain. But what if I told you there was a cheap and effective way to get hold of this? A free resource to better read the Bitcoin markets and be 2 steps ahead. In this video, I'm going to show you how you can use the Bitcoin options market to your advantage. Not only when it comes to option analysis, but also when trying to determine Bitcoin's price direction. All that is to help equip you with the tools you need to get the market edge. Before we get into the juicy details, a few caveats. Firstly, I am not a qualified financial advisor. Sorry, didn't take that test. That means that whatever I'm about to say should solely be used as an educational resource, one to supplement your own research with. With that out of the way, I would like to welcome all new viewers. The name is Guy, Crypto Guy. And over here at Coin Bureau HQ, it's my mission to bring you top-notch crypto content. From news to reviews and dedicated overviews, it's all on my radar. If this is the sort of knowledge your brain soaks up, then pay a visit to that subscribe button and ping that notification bell so you don't fall behind on your crypto studies. Oh, and I would also like to draw your attention to these timestamps over here. These are here purely for your convenience, so feel free to use them if you're really strapped for time. All set? Let's go. Now, I want to start with a quick beginner's overview of options. If you're already fully clued up, feel free to skip ahead. Quite simply, an option is a financial instrument that gives the holder the right to buy or sell an asset at a pre-specified time and at a pre-specified price. A call option gives you the right to buy the asset, whereas a put option gives you the right to sell the asset. Because these options are instruments that give you, well, optionality, there is a cost that comes with them. This is the option premium, and it is the price of the option. Options are themselves derivative instruments that are traded on their own market, which is separate from the spot market. You can think of it as analogous to the futures and spot markets. Now, there are a lot of variables that will impact on the premium of an option. These are collectively called the Greeks, and they are inputs into the legendary Black-Scholes pricing equation right over here. Now, if this appears daunting to you, don't worry. All you need to understand are the main drivers of an option's price. The first thing that I want to introduce you to is the moneyness of the option. This refers to whether an option is in the money or out of the money. Basically, if you're looking at a call option, if the spot price, S, is above the strike price, K, then the option is in the money. Conversely, if the spot is below the strike, it is out of the money. As I'm sure you'll have guessed, when you have the strike equal to the spot, then it is at the money. For a put option, you just flip the arguments for the in or out of the money levels. The moneyness of an option is important as it impacts on the delta variable in the Black-Scholes right here. Delta is a measure of how sensitive the price of the option is to a change in the price of the underlying asset. Then you have other factors, such as the implied volatility. This is also a very important input in an option price, and generally the higher the implied volatility, the higher the price of the option. It's only logical. A more volatile asset will demand a higher option price to make up for the risk in said asset. Then you have the time to expiry. This is also generally positively correlated with price, as the longer that you have to expire, the more time value you have of the option. The sensitivity of the price of the option to the rate of change in time is called theta. This time value also makes sense when you think about it. The longer you have till the expiry of the option, the longer the time period in which the option could either be in or out of the money. Now, these are just some of the main factors that will impact on the price of an option, and they are perhaps the most important for you to understand if you want to trade them. However, if you would like a more in-depth overview of the rest of the factors, then I encourage you to check out my video I made at the beginning of the year right over here. What I really want to explore in this video is how to use the option data to infer market trends and sentiment. So, let's take a look at some of these. Firstly, I want to discuss the put-call ratio. This is a measure of the ratio of the open interest or the volume of the puts versus the calls. For those who don't know, the open interest is a measure of the total amount of notional outstanding on a futures or options position. And the volume is, of course, the total amount of options or futures that have been traded in a certain period. So, for example, if we're talking about the open interest put-call ratio, we're measuring the total notional outstanding value of all puts to that of the notional outstanding value of all calls. So, what can we read from a put-call ratio? Well, it's able to give us a rough idea of general sentiment in the market. If there is more open interest outstanding for puts than calls, then that means there are larger bearish bets than bullish bets. Hence, a put-call ratio of greater than 1 is viewed as more bearish than a ratio of less than 1, and vice versa. You can also view the put-call ratio through time to get a feeling for how this broader market sentiment has changed. Over here, you can see the put-call ratio over on Skew.com. As you can see, the ratio is slightly more than 1 when viewed with the volume metric and less than 1 when viewed with the open interest. I generally tend to use the open interest metric as this gives a more reliable indicator of outstanding trades than the total value of all the options being traded. So, based on a put-call ratio of 1.36, it means that the put option open interest is about 36% more than the corresponding call notional outstanding. So, on balance, option market participants have more puts outstanding than they do calls. Now, you may be wondering, why is this relevant? Well, knowing how options traders are positioning themselves can give you a rough idea of which way they expect the spot market to go. And you should not really be fixated on the absolute number of the put-call ratio, but rather on how it moves, whether it's increasing or decreasing. This can help give you a better sense of how that sentiment is changing. Okay, so that's the put-call ratio. Now, of course, all this gives you is an overview of how the broader market is positioned. It doesn't really allow us to get a direct comparison in the pricing of puts or calls. This is where the option skew comes in. So, let's take a look at that now. Option skew is a measure of the relative richness of the put versus the call options expressed in terms of implied volatility. Okay, that's a bit of a mouthful, so let's chew it over a bit more. It's a measure of how much higher the implied volatility of put options with a specific delta are to call options with the same delta, all normalized by the at-the-money volatility. Here is the equation that's used to calculate the option 25 delta skew. As you can see, we're trying to get a measure of how much more implied volatility there is on the puts than the calls relative to a standard measure of the implied volatility. Given the direct relationship between implied volatility and option premiums, you can also view this ratio as a rough measure of how much more the cost of puts are to calls. If we have two options with a similar sensitivity to the price of the underlying asset, how much more are people willing to pay to take on the puts, bearish, versus to take on the bullish view with calls? Let's take a look at a quick example, shall we? Let's say that the 25 delta option skew is sitting at about 20%. This basically means that the implied volatility of a put option is about 20% greater than that of a call. We can also therefore infer that the price of similar put options is greater than the calls to a similar degree. This therefore means that option buyers are willing to pay more to buy put options than they are to pay for calls with exactly the same parameters. You can view it as a more bearish sign. We can also say the opposite if the ratio is negative. Still with me so far? By the way, if anything is unclear, feel free to fire a question in the comments and I'll try to get back to you. Now, much like the case with the put-call ratio, you can view the option skew over time. This is helpful as it allows you to get a sense of how the relative value, and hence sentiment, has changed recently. For example, here you can see the 25 delta option skews on Skew.com for the past 3 months. This is for a range of different option expiry times from 1 week all the way out to 6 months. Let's narrow in on that 3-month option skew. As you can see, this is currently at negative 27%. This implies that the call options have a much higher implied volatility, and hence the premium is greater than the puts, generally a bullish sign. However, if we take a look at how this has moved over the past 3 months, you can see that it's been trending lower, from being about on par in late September to the current level. So what we can read from this is that market participants are paying more for calls than the puts. Not only that, but the difference has increased over time, which shows that their bullishness has too. And if you take a look at the spot price of Bitcoin over the period, you can see that it's quite well correlated with this fall in the skew. I should also, of course, point out that option skew is much broader than just this. You can compare the skew across the entire volatility term structure. You have something called the volatility smile, which illustrates this well. But that's an entirely different topic for another video. All you need to know about option skew is that it's a helpful metric that I often use in order to gauge relative value and sentiment of an option. Anywho, so that's the skew. Now I want to take a look at another metric. How cool would it be if you could use the option price to calculate the probability of Bitcoin being above a certain price at maturity? Well, that's actually a reality thanks to the Black-Scholes model that I mentioned earlier. You see, assuming that you have the price of an option as well as all the other parameters in this equation, you can back out the potential price distribution of an asset on expiry. For those of you who did stats at uni, you'll know all about probability density functions like the normal distribution here. If it's foreign to you, don't worry. All that we're doing here is using the market parameters of the options in order to back out the probability of it being above a chosen strike price. This is also something that you don't have to calculate yourself. Skew.com has a graph that calculates this for us. Here you can see the probability distribution for a number of different option expiries. Let's take a look at the December 2020 option just to isolate it. As you can see, the probability of the price being above 22k on the 25th of December is about 28%. If we move down more, we can see that the probability of being above 24k is about 19%. We can also take a look at the longer-term options like the March and June 2021 ones to draw similar probabilities. So, what can these probabilities tell you? Well, they can give you a rough idea of how likely certain future prices are based on pricing in the options market. I like to use these as they help to give me a sense of more realistic outcomes. In crypto, we're quite desensitized to these parabolic price predictions. So much so that we can sometimes get caught up in the hype. However, over on the options market, most of the participants taking out the largest positions are professional investors. I'm talking institutional funds and sophisticated market makers. The prices that they are willing to pay for option protection and exposure are likely to be a better benchmark for their real price predictions than what they claim on TV. Now, of course, I should also caveat that you should not use this as any sort of Bible. It's just a probability measure backed out from market data. It's a useful data point you can use in order to further inform your analysis. Okay, so that is option price probabilities. Something else that I really want to touch on now is the option expiry dates. More specifically, the impact that this tends to have on the spot market. If you follow any sort of crypto news website or trading group, you'll sometimes hear reference to the option expiry dates. If there are a lot of options that are expiring on the date, then this could be an indication that there's likely to be quite a lot of volatility on the day. So the important question here is, why? And how can you judge the likely price direction on the expiry date? Let's start with that first one. There is volatility around these expiry dates because market participants are trying to adjust their positions for physical delivery of the underlying asset. Similarly, some market makers may need to adjust their hedge positions in the spot market as they approach these pivotal moments in the option price. So what you have is a situation in which option expiry events are having a direct impact on the underlying spot markets. When there's a large number of outstanding options, the impact on the spot market is likely to be that much greater. This is something that's been known in the equity markets for a number of years. These are sometimes termed the expiry weeks, where volatility in the underlying share starts to pick up. However, Given the growth of Bitcoin options, we've also seen these instruments impacting the Bitcoin spot price. This usually tends to happen about 2 days before the actual expiry. Those participants that hold the option may either close out of their position or roll forward into new options on the expiry date. Okay, so we know that options expiry dates are usually dates of interest when it comes to price movements. But is there a way to get a sense of which way it's likely to move? Well, there's no hard and fast way, but you can get a vague idea by taking a deeper look into the options order books themselves. In this case, I'm going to be taking a look at the Deribit order books. They are the exchange with the most liquidity and functionality for retail traders. Link to sign up is in the description. So, let's take a look at some options that are about to expire soon. How about these 11th of December ones over here? Now, what we're looking for is to determine how much theoretical buying or selling pressure is likely to come in the spot market from the expiry from these calls or puts in the options market. Basically, to get a rough back-of-the-envelope put-call ratio. Let's further the range of options to those that are relatively close to the money level. Let's choose an acceptable range for both. In this case, I'm of the view that on the 11th of December, Bitcoin is likely to be within the 18K to 21.5K level. Hence, I take a look at all the options that fall into this range. Now, I want to try and determine the total outstanding notional or open interest on the call and then the put side. With these option expirations, the total open interest on the calls is about 4,200 Bitcoin, whereas on the put side, the total notional outstanding is about 1,770 Bitcoin. So, what this shows us is that as we roll forward towards the December 12th expiry date, there are a lot more call positions in the market, almost 2.4 times more. So, theoretically, this means that there is more chance of there being buying pressure in the spot market as we head into the expiry than selling pressure. A more bullishly positioned market. Now, of course, I should caveat that at the time of doing this analysis, there was still about 2 weeks to expiry. A lot can change closer to the expiry date. And as I mentioned before, in the Bitcoin markets, the impact on spot markets of the option expiry only tends to be felt 2 or 3 days before. So if you're going to be using this analysis method, I would encourage you to re-examine the relative open interest balance as we get closer to expiry time. You should also note that this is not a science. There are many other factors that can swing the price on expiry. Let's not forget that you also have the impact of the futures markets as well as large whale orders going through on the spot market. But it is a handy guide that I use from time to time. Okay, I think I'm getting a bit carried away with this video, so it's time to start wrapping things up. The truth is that the intricacies of this relationship between the derivatives and spot markets fascinate me, and I thought you folks might be interested too. Now, I must admit that there may be some things here that are hard to grasp, and that's totally okay. The truth is that most people who trade options don't really focus too much on the underlying equations. They're more concerned about overarching concepts. Knowing exactly how the 25 delta skew is calculated is of way lesser importance than understanding what it means. What does it show about how the market has positioned and how you can use that information in your broader research toolbox? Similarly, having a rough idea of what price distributions are in the future can help you adjust your expectations. Why listen to the moonshot calls of some crypto celeb when you can get a rough idea of price probabilities from the options markets? And it always helps to keep an eye on option expiry dates. Even if you don't try to infer a particular price direction, it has been shown that these dates cause spot market volatility. By having these dates pinned in your calendar, you're better prepared to deal with any potential volatility that could result. There's nothing worse than being caught off guard by a large price gap, be it up or down. So yes, I hope that you good people find some of these indicators and tools helpful in your price analysis. They can be that much more interesting when actually used to trade options themselves. Perhaps a topic for another video. If you're still here, I salute you. That was a pretty involved subject, but I hope it served its purpose. But now, I really need to hear from you fine people. Do any of you folks have any questions at all for me? Does anyone use any other options data to inform their trading? I'd love to know in the comments down below. Oh, and while you folks are down there, be sure to check out my personal deals page. It's a collection of some of the best promos that I could find, exclusively for Coin Bureau viewers. So yes, check it out. Finally, if you got value from this video, then turn that like button blue and smash that subscribe button. I hope to be doing a follow-up to this video, and of course you won't want to miss it. Oh, you guys still here? Well then, I may as well let you in on a little secret. What I covered in that video was only just the tip of the iceberg. Everything else I include in my weekly email newsletter. It's basically a compilation of all the interesting content that may have flown under your radar. News, reviews, analysis, as well as a breakdown of my personal portfolio. Want to join? Well, don't delay. Just scoot on over to the description where you'll find a link to my sign-up form. There, you can enter your email address, hit submit, confirm your email, and hey presto, you're a Coin Bureau insider. My next newsletter is being worked on as we speak, and you won't want to miss it. I'll see you next time, folks.